Geoff Beattie is the chairman of Relay Ventures and CEO of Generation Capital. In this episode, Geoff shares forward his experience as a financial planner and expert on the global economy.
Things in Canada?
Going reasonably well, but you can imagine at times like this, we're sort of a price taker from the rest of the world. And so the stability of what's going on in the U.S. and the issues that they have in places.
In the UK.
We have our central banker, articulates very, very, sort of thoughtful policy. But at the end of the day, the most important thing he does every week is understand what Mr. Powell's going to do. Because if we get out of step with him, not only do we import 50% of everything we use from the U.S., we'll import inflation and recession.
Well, yeah, there are some things you want to leave at the border.
Exactly. How are you doing?
Good. Geoff, your career has been an interesting one. As I understand it, you started in the legal world and had a very successful career there in Toronto in Canada. And as I understand it, you were doing a lot of work with a family holding company that handled the Thompson family money. And they had a fellow there who'd been there a long time and done a wonderful job for them. And you interacted with them so much and got to know them so well, and that they suggested that maybe you take a detour in your career and switch to a management side of the world, particularly wealth management. Is that essentially correct?
Absolutely. And, I go back from time to time and try to retrace the steps in my career when I'm talking to young people or people trying to develop what they want to do. And, it's interesting. You can join the dots in hindsight, but at the time, it's, as you well know, where you end up has an awful lot to do with the people you work with.
Accidents happen and opportunities are something that if you're well prepared for and have an open attitude about change, you can make the most of it like you did. And I think my understanding is that you did an unbelievably good job for the family in managing their money over many years. And when I say managing the money, it's beyond just making investments. It's a lot around estate planning and generational planning. It's generational development. It's tax planning. It's not only growing the fortune, but maintaining it and providing all the risk management that you have to do. And you're really involved with the lives of the people whose assets you're caring for, because understanding their needs is an important part of how you do and did your job.
No, absolutely. And I was lucky. And I think if I attribute the success to anything is that, I got to work in a culture that suited me, which, seems obvious to a lot of people when they think about the work environment. But I enjoyed the relationship with the family. I enjoyed a lot of trust. I obviously gave them a lot of trust. They gave me a lot of trust. We were aligned in terms of what was important, the values and the principles of how they wanted to grow and build as a business. One of the things that stuck with me is Ken Thompson was always saying, tell me where we could be in 10 years. I know where we are today. Yeah. I know where we are today, but let's talk about where we could be in 10 years if we did certain things or failed to do certain things. What do you think about that? It seemed like a pretty basic conversation at the time, but it's actually formed a lot of the philosophy of the way I think about everything today.
And so let's look at the next career step you took, which is to form Generation Capital. So you left your role with the Thompson family and created your own shop called Generation Capital. And was that in 2013?
Yep.
And what was your plan for Generation Capital, and what is it today?
I think we all at some stage in our life, want to go out and engage in the world as a principal. You want to determine whether how you think and what you do and what you can control is sort of fundamentally under your own control. I had a very successful and enjoyable career as what I think of as an agent. whether it was in the legal profession or whether it was in banking or, even my time at Woodbridge and Thompson, you were serving a slightly bigger purpose with, groups of people and partners and things like that, that you were part of a bigger plan. I wouldn't say I had an entrepreneurial bent, but I did want to do something that I could bring together everything that I'd sort of cared about or thought about over the years into something that I can control and build, including, attracting and retaining the type of people that I thought were necessary to be successful. You're right. We're 7-8 years into it now, and it's been hugely successful. And I think it's a model that a lot of people are attracted to around the management of, families and high net worth assets.
The name gives away a lot of what your intention was. What kinds of people, what kinds of families are attracted to putting money with Generation Capital to manage their very important assets?
The purpose behind Generation Capital was obviously, the idea of generations of families, but also the concept of generating capital and generating wealth. And, generation has the connotation of longer periods rather than shorter periods. The philosophy of what we have is, the fortunate thing is that you have capital. Making more is not a strategy. Looking after what we have responsibly is a strategy. And using that capital to achieve the goals that you want to achieve in life is something we need to sit down and talk about. Short-term benchmarks, trading strategies that are pretty much directed towards, making money per se, are not really part of the way we think about it. We think much more in terms of, as I said earlier, what needs to be true for this capital to have both, grown and been stewarded responsibly in 10 years. What are the things that we need to do today to give us the best shot at that? And, we try to make the job as easy as possible. We like to take out some of those headwinds that can cause problems like, tax leakage, reinvestment risk, over leveraging and being caught out at the wrong times of cycles. One of the underpinnings of longer term investment strategy is I'm optimistic that a number of very good things will happen over the course of the next 10 or 15 years. And I'm realistic that some not so good things will happen and we'll have to go through some more difficult cycles. We fundamentally don't try to predict when those will happen. We just accept as a fact that they will. We probably have a bias that more good things than bad things will happen. So the odds are sort of stacked in our favor, and we manage accordingly.
Do you have a plan that you dust off and revisit periodically that says, if X happens, then here's how we'll respond and reposition?
We do. And, we also have some cornerstone principles about, no matter where interest rates are or how attractive capital raising is, we have some real guideposts around leverage. We make sure that our debt never exceeds, 5 years of free cash flow. We make sure that it's always matched against assets. We're careful to match duration. We don't want to inadvertently get into carry trades of borrowing short and lending long, so to speak. Yep. We've also been humbled over the years when we do look backs and realize that, a huge part of our success is not our own personal perceived genius of picking better things than everyone else. It's managing consistently and properly around asset allocation, proper risk models, not getting in our own way, as I said earlier, with tax leakage or, one of the things that people have a very hard time valuing as an investment strategy are the importance and value of things like liquidity or the risk of reinvestment at times when markets aren't attractive. And, you've heard the whole adage that, if you're out of the stock market 10 of the last 300 days and they're the wrong 10 days, your returns are half of what they might have ordinarily been.
Yep.
I don't subscribe to all of that, but it does continue to repeat the lesson that the flow of return and the flow of capital and the consistency of approach has more to do with where you end up than being smarter than your neighbor.
Truth be told, you're a friend that I go to regularly to get that big picture point of view. We all have a circle, and you're in my circle of people. I go to for a touchstone on big picture. This too shall pass. Let's put it in perspective. You always have a reference to history, and this trend looks like a trend in the 1970s. So it seems to me that your shop spends a lot of time on research and macro research in particular. Of course, you look at research about specific products and how they might fit into your menu of opportunities to do your day job. But it seems to me that you in particular and your shop have a real bias toward big trends, macro, and history.
Absolutely. And, we are fundamentally, growth investors. We believe in the future of the economies and the markets in which we're most actively involved in from an investment point of view. The reason why, the returns for growth are better than, let's say, value is because there's so much uncertainty about where that growth is going to come from, over what period of time it's really going to manifest. And, value investing, is identifying a problem and betting on the fact that it'll correct itself, which is sort of a binary event. And if you happen to be right, it happens. But then you got to invent another one and another one and another one. One of the things that I think is very much grounded in our investment approach around here is we force ourselves to ground all of our thinking in reality. We force ourselves to develop tried and true underwriting skills, and we are careful not to erase them or manipulate them at different times in the market to suit our desires or needs. That's easier said than done because, everybody has a bias to wanting to do things, a bias to action, but also a bias to thinking that they can, figure things out this time, notwithstanding, a lot of the data and analysis and reality. And grounding yourself in the reality of the situation also leaves open the possibility that you can't find the reality of a situation. And right now, I think we all are in a very, very confusing time in the world because we've learned over the last 10 years that the interconnection of global economies acts in ways that only find out when something like the Ukrainian war happened. I don't think 5 years ago you could have built a model around energy pricing or global energy. I don't think anyone would have been able to predict exactly what's happening through all of this. Although, as you invest and think about it, you don't want to be in the game of prediction, but you certainly want to be in the game of possibility. People who spent time 5 years ago to say there are some real geopolitical possibilities that could upset this apple cart. All that has to go into your risk management.
Over the past couple of years, in conversations that we've had, you've spoken about something that, as an American, we're blessed and cursed with such a big domestic market that we tend to think about the market as being only domestic. And you just pointed out that no market is only domestic. And being a Canadian, you know that you're tethered to a rather large neighbor who gets to rock the boat. And you have to be very conscious of the wake there. And in those discussions, you talked about the role of where you leave your assets in terms of currencies and how right you can be about a trend. And if you're in the wrong currency, it's completely undermined. How do you think about the vagaries of currency?
Well, currency obviously is very complicated. But if you think about it, as the ultimate store of value, and, this is informed a lot of people's views around, things like gold and Bitcoin and others, is that, one of the things that I've certainly looked at over the years is we've invested, obviously, primarily as a US dollar investor, not so much as a view on currency as where the type of investments and the investments that we make tend to present themselves as US dollar investments just by the nature of the investment activity. And, you look at, the US market, certainly in financial assets and things like that, is so much more developed and so much more liquid and, so much better service than the rest of the world. Even when we thought we were diversifying into different economies and potentially different currencies, it's amazing how much of it is all tethered back to the US dollar. And I think we're seeing that right now and this weekend in Washington at these IMF meetings, the continuing strengthening of the US dollar, notwithstanding the backdrop of US economic conditions over the last 10 years. Very few people would have necessarily been able to see the impact of the US dollar on the rest of the world and what it may do. And the reason why the conversations are going on in Washington is the US dollar and the US economy is very dependent on the rest of the world economy and stability because of some of the things we've talked about around globalization and the interconnection of funding.
Well, let's hit on some of those, if you would. Your thoughts about Bitcoin and how do you play that?
I've sort of become a follower and a disciple of the Jamie Dimon approach to, Bitcoin, because I see it from a banker's point of view whose business is to traffic in money. I have a very simplistic view, and that is, until I can put something in my pocket one day and have a reasonable amount of comfort of what it's going to be worth the next day, I can't get myself comfortable with owning it other than as a speculative asset. And the problem I've had with it as a speculative asset is I've never been able to really understand what I'm speculating on. I'm a proponent of the concept from a technology and digital point of view.
I share that with you.
And I'm an opposer of it as a currency or a store of value.
The technology is really interesting. Sitting on top of a blockchain clearly is going to have big impacts on us. But I'll steal your skepticism and inherit that. A good friend of mine told me recently that 5 years ago there were a dozen family offices established in Singapore, and today it's probably 150. What's happening there? Is that an Asia play? Is that a risk management play? Your thoughts on where family offices and where they're domiciled, does that make a difference? And do you see that trend, and what impact does it have?
I think it's just following the trend that we've seen over the last 50 years of financial management and proliferation of asset classes, proliferation of expertise. 25 years ago, a family office was that subleased space at the other end of the floor from the operating company, and the CFO did double duty of looking after the family business as well as the
operating company,
the family members. And over 25 years, that has transpired into what we still think of as family investment offices that are really private institutional investors run by professional investors with differentiated strategies as to what they're going to do. And I would say, the differentiated strategies usually evolve out of what generation of family wealth they're now stewarding, whether it's the first or the fourth, oftentimes where the money's been made. A lot of great family wealth has been made out of long dated concentrated bets. and they're a little more reluctant to move into a broad-based, fully taxable, diversified investment portfolio run by third-party managers. Whereas, people that have perhaps made their wealth through, in effect, investing themselves would be more inclined to a different style.
Now, you mentioned tax several times. If I'm running a big mutual fund, I really don't have much of a concern about taxes. A lot of my investors are going to not taxpayers, but when you're representing families as you do, tax has to be an important component. How do you think about the tax question? You talked about tax leakage. Give us a little color on what you're thinking about there.
Yeah, so I think of tax leakage from an investment management perspective. I obviously have an enormous amount of respect and am very focused on tax compliance, as we are with regulatory compliance. I mean, all of those things, are very, very important parts of managing large enterprises, because they are the type of things that can shoot a hole in the side of your boat, so to speak. But from an investment point of view, the market is made up of all kinds of different participants, including non-taxable entities like endowments and pension plans, and various other things. And we've gone through a long period of time where it's been a bull market in asset class proliferation. It's been a bull market in private equity and hedge funds and things like that. And these organizations, for their own purposes, tend to market their wares on a pre-tax basis because it looks more attractive. It suits the needs of some of their non-taxable investors. Until you've been through long cycles and you understand the impact of different strategies on tax, it can have a very material impact on your overall returns. And if you're in the business of generating long-term returns, you have to be in the business of managing a very material component of that, which is tax planning.
Yeah, just to take it to the individual in the U.S., where we have 401ks and other income earning tax deferral situations to prepare for retirement, the ability to compound your investment returns over a long period of time before they're taxed is a tremendous advantage that the Congress sewed into the tax code to replace what used to be a pension-based system. And their individuals can see the benefit. If you get $1 today and you can invest that and not have to pay taxes on it, versus if you have 50 cents today, the compounding is extraordinarily beneficial in a no tax environment, correct?
Take a private equity or any kind of corporate investment type vehicle where over a 10-year period, you earn the identical top-line return on owning one business that you bought day one and sold day 10, versus three different businesses that were bought, potentially maybe levered up a little bit, sold, the proceeds were reinvested on a similar basis, sold in 3 years. And that churn in trading strategy, you take a look at the after-tax return and what we like to think cash on cash type returns, because that's all you have at the end of the day. It's eye popping. When we own good businesses that have good return characteristics and are sustainable and resilient over a longer period of time, you can, talk about the principles underlying what Warren Buffett talks about and Berkshire Hathaway and, sustainable brands and long economic. The performance is one thing, but the efficiency on return on capital over a period of time is what really changes the game over, if you're able to hold, we can do the math in your head, but, a 10% IRR for 20 years with a deferred tax liability versus 5 businesses at 15% return, which, by the way, is really hard to find 5 over a 20-year period. You give up an awful lot of capital.